Hi everyone, I'm Amit Parakh and I would be taking you through 10 key questions in economics quite relevant for your CFA Level 1 exam. So there we go. So here you have question 1, which is following indicates the market demand function Q is equal to 84 minus 3.1 P plus 0.8 I plus 0.9 Px. Now Q out here indicates the quantity demanded, P indicates the price of the concerned product, I is the income of the consumer, and Px is the price of some other product, which could be a substitute or a complementary. Now currently P, which is the price, is prevailing at $38, I is currently $100, and Px is 18. Alright, so what we need to compute, the cross price elasticity, the income elasticity, and the price elasticity. So how would you do that? Let's understand. So let me first work out the price elasticity. Now if you look at the coefficient of P, it's minus 3.1. okay, so that would indicate that the change in quantity by the change in price is equal to minus 3.1. So that's nothing but the slope, right? So the change in y by the change in x is equal to minus 3.1. So this is your delta Q by delta P. We need to find out the price elasticity. Now price elasticity is percentage change in quantity divided by the percentage change in price, which is change in Q by Q into change in P by P. I mean to say this is division. So change in Q by Q divided by change in P by P, which is change in Q by change in P into P by Q. Alright, now we know that change in Q by change in P is minus 3.1. So let's put that minus 3.1 into P by Q. What is P? P currently is 38. Q currently is, we need to find out. So we need to find out what Q would be. So let's get Q. Q is equal to 84 minus 3.1 into 38. So I'm just substituting, plus 0.8 I, which is 100. So plus 0.9 px, which is 18. So let's get this. So this would be 62.4. So let's put that. So instead of Q, I substitute it with 62.4. So this would give me the price elasticity, and this turns out to be minus 1.9. So you would say, hey, price elasticity is going to be minus 1.9, and minus is quite predictable sign, because there exists an inverse relationship between price and quantity demanded. Now let's look at income elasticity. Now let me try and utilize this space to calculate income elasticity. Now we know income elasticity is the percentage change in quantity divided by the percentage change in income, which basically would give me change in Q by change in I into I by Q. Alright, so the change in quantity by change in income will be represented by this coefficient, which is 0.8. So let's put that 0.8 into I by Q. Income happens to be 100, and Q, as we had calculated, currently is 62.4. So this would give me the income elasticity, which would be 1.3 if my calculation goes correct. So that's how we would calculate the income elasticity. Coming over to cross price elasticity. Now cross price elasticity gets computed very similar to the way we calculate price elasticity. It's just that we look to calculate the change in quantity demanded of product, let's say Y, in response to, let's say, the percentage change in price of product X. So cross price elasticity. So cross price elasticity of, so I'm trying to compute this over here, will be equal to the percentage change in quantity of, let's say, y on account of the percentage change in price of x. So that will be change in q by change in px into px by q. So that would be change in q by change in px will be 0.9, and this is going to be 18 divided by 62.4, and that would give me 0.3. all right, so that computes the cross price elasticity. Now, given that we've got cross price elasticity as positive, what does it indicate? I mean, let's look at it very simply over here. Let's say the price of x goes up. What happens to q? Now you would say q as well would go up. So if I keep everything else constant, if px goes up, then q as well goes up. So if the price of something is going up, of some other product is going up, and the quantity demanded of this product is going up, this only indicates that these two should be competing goods. They should be substitutes. So when you have a positive cross price elasticity, it's indicative of a competing good, and greater the elasticity, that means greater is the substitution factor as far as that good is concerned vis-a-vis the concerned good, vis-a-vis q. So if x and y that we are talking about, greater the cross price elasticity, and if it's positive, then it indicates that the two goods are actually competitive goods. all right, now in case if the cross price elasticity turns out to be very low, almost in the neutral range, we would say, well, it's neither complementary, neither complementing good nor a competitive good. Now I've taken up this example just to touch upon these three concepts. I'm quite aware that you would not get question in this form. You would be facing an MCQ, but the whole idea out here was to come up with some exhaustive questions which have multiple touch points, so that you by way of these questions you would be able to get familiar with some relevant concepts which are quite important for your exam. Okay, so I hope this is clear to all of you. So let's now move on to the next question. So John, a student of economics, makes the following statement, or rather statements. Statement 1, all Giffen goods are inferior, but not all inferior goods are Giffen goods. And statement 2 is, there is no difference between Giffen goods and Veblen goods. Are the above statements true or false? Again, reiterating, you're not going to get a question where they're going to ask you true or false. Of course, they can easily recreate the same question in an MCQ form. Now, the whole idea of taking up this question was to touch upon Giffen goods, Veblen goods, inferior goods, because very often they do set questions around these concepts. So let's understand what are inferior goods. Now, we all would like to believe that as income goes up, the consumption of the good as well would go up. So the quantity demanded for some product should generally go up. Now that is so for most of the products, but then there are goods when income goes up, the quantity, instead of going up, it goes down. Now those goods are known as inferior goods. These goods are known as inferior goods. So normally the income elasticity is positive, but for inferior goods the income elasticity turns out to be negative. all right, so that's inferior goods. Let's come to Giffen goods. Now Giffen goods, okay, before I get on to Giffen goods, let me tell you, the law of demand states that if the price goes up, the quantity demanded goes down. If the price goes down, the quantity demanded goes up, where we keep all the other factors constant. So something like income, price of the substitutes or complementary goods, I mean all the other factors are being kept constant. It's just price of the product of the goods that is being kept variable, and we look at in isolation the response, the sensitivity of demand to changes in price. Okay, now I'm sure all of you would have gone through the theory, and you would have realized that when the price of goods change, let's say if the price of goods go down, why is it that the demand goes up? Well, when the price goes down, there are two effects which come into play. One is the substitution effect and the other is the income effect. When the price of goods go down, the goods become cheaper vis-a-vis other goods. So there is a tendency to substitute other goods with these goods. and hence the demand goes up. There's also an income effect, because when the price goes down, the real wealth, the real income of the consumers go up. And when the real income, or let's say the income of the consumer goes up, their tendency to consume more would come into play. And hence income effect as well as substitution effect taken together, they tend to reinforce the rise in demand. Alright, so that explains why quantity demanded would go up when prices go down, because it's basically the income effect and the substitution effect which are collectively into play. Now for inferior goods, given that we know that the income effect is negative, it's just the opposite of what we would believe for normal goods. So for inferior goods, it could be that when price goes down, your quantity demanded should go up thanks to substitution effect. Alright. Alright, and your quantity demanded should also go up on account of income effect. That's for normal goods. But for inferior goods, when price goes down, your quantity demanded should go up thanks to substitution effect, but should come down on account of the income effect. So there's a current and a counter current which are in play. More often than not, the substitution effect overwhelms the income effect, and net you would still see the quantity going up when the prices are going down. But then you have Giffen goods where the income effect dominates the substitution effect. Okay, so I'm talking about inferior goods where your income effect dominates the substitution effect, as a result of which when price goes down, the quantity demanded goes down. When price goes up, the quantity demanded goes up as well. Now that's what inferior goods are. Sorry, I stand corrected. That's what Giffen goods are. So Giffen goods would tend to be a subset within inferior goods. So Giffen goods are part of inferior goods. This is a special category of inferior goods where the income effect is negative because it's inferior, but then the income effect is so very strong that it overwhelms, over dominates the substitution effect net, on account of which when price goes up, the quantity demanded goes up. So we are talking about those kind of goods. So here you have Giffen goods, which is a special category within inferior goods. So may I say all Giffen goods are inferior, but then not all inferior goods would be Giffen goods. This is very much true. Let's come to the second statement, which says that there's no difference between Giffen goods and Veblen goods. So let's understand what are Veblen goods. Now Veblen goods are basically status goods. So these are let's say something like a diamond. Well, one could talk about conspicuous consumption goods, where people generally would tend to buy the expensive goods because they are perceived as expensive. And for instance, something which is very rare, a rare stone which is not really of much utility, but the sheer price of it gives a sense of value to those goods. So where the value gets conceived on account of the high price of those goods. So for Veblen goods, which are essentially status goods or conspicuous consumption goods, their demand is there on sheer account of their high price. So to that extent, Veblen goods, they defy the basic tenet of the law of demand, right? So in a sense, Veblen goods become an exception to law of demand, unlike Giffen goods, which still comply with the law of demand. It's simply that Giffen goods, the negative income effect dominates the substitution effect, and hence you do see that when price goes down, quantity demanded goes down. When price goes up, quantity demanded goes up. Very similar to what apparently we would see it in Veblen goods as well, but that's merely the characteristic which seems to be or let's say the behavior which seems to be similar between the two, but they are basically different goods. Giffen goods are inferior goods. Veblen goods are status goods. These are conspicuous goods. Giffen goods do not defy the law of demand, while Veblen goods do. Alright, so This statement is far from truth, so we would say, well, this is false. Okay, so let's now move on. I would reiterate that these concepts are quite important, gets very often tested in the exam, and you should pay special attention to it. Move on. Let's look at the third question. Well, this is a nice one. The individual monthly demand function of a library is given as Q is equal to 20 minus 4P. Q is the quantity, P is the price. Q indicates the demand, the units demanded, P indicates the price per unit. Where Q is the number of books borrowed in a month, so in a sense it indicates a monthly demand, and P is the price charged for every book borrowed. The marginal cost of the library is $2. So for every book borrowed, the library on an incremental basis incurs around $2. Alright, so we need to set up the demand curve. The next question is, if the price is set up equal to marginal cost, how many books would be borrowed by an individual? The third question is, what is the consumer surplus at the above levels? And the fourth question is, what is the monthly membership fee, the bulk fee, monthly membership fee that can be set by the library? So let's look at what the demand curve would look like. Now we've been given that Q is equal to 20 minus 4P. So if I make P the subject of the equation, because generally in demand curve you will have P as a y-axis, P will be equal to Q minus 20 by 4, which makes it 0.25 Q, or rather minus sign would be there, plus 5. Alright, so this becomes the demand curve. P is equal to 5 minus 0.25 Q. So what would it look like graphically? Let us see. So when you have P over here, you have Q over here. So when Q is 0, P shall be equal to 5. So this is one point that we will have, and of course the other point being 20. Alright, because 20 into minus 0.25 becomes 5, minus 5 plus 5 becomes 0. So this is how graphically the curve would look like. Alright, so that's the demand curve. Now, so we've done this. So set up the demand curve. Well, this is the demand curve equation. If the price is set equal to marginal cost, how many books would be borrowed by an individual? Now the marginal cost is $2. So if I take Q as P as 2, 4 into 2, 8, 20 minus 8 becomes 12. So the quantity, the number of books that would be borrowed will be 12, because that's the value of Q when P is equal to 2. Okay, so 20 minus 4 into 2 makes it 12. So which basically means that if I set the price at $2, my quantity demanded would be somewhere over here, which is 12. Alright. Now, what's the third question? What is the consumer surplus at the above level? Now, at these levels, this is what your consumer surplus is going to be, isn't it? That's what we've learned. Alright, so the distance, rather the area between the price line and the demand line, this area which gets captured is your consumer surplus. So how much would this be? Well, this looks like a triangle. So where we have the height is 3, the base is 12. So let's get this. Half into base, which is 12, into height, which is 3. So that gives me 18. So my consumer surplus is going to be 18. Alright. Next question. What is the monthly membership fee that can be set by the library? And this is a very good one. This would require a bit of thinking. Now the library could be quite well off by charging a membership fee of $18, which is nothing but the consumer surplus. So what the library could propose is an $18 membership fee. So this is the membership fee plus a $2 price that they would charge for every book borrowed. Okay, for every book borrowed, they're going to charge $2, and they would keep the monthly membership bulk fee at $18. Now how did we get this $18? Well, that's basically the consumer surplus. So the whole idea is to charge from the customer what at maximum he can give. Think of it, if the customer would look to borrow 12 books if the price is set at $2, the maximum that the library can take away from the customer is the entire surplus that he looks to enjoy, which is $18 plus this particular area. Now this particular area would get well covered by charging $2 per book, and $18 is the upfront fee that they can charge. This popularly is known as the two-part pricing, where basically there is this one part which is the upfront bulk fee, and of course the other which is variable. So let's look at this question. LNG Inc. is a monopoly. Its marginal cost is $40 and its average cost is $70. Price elasticity of demand is 1.5. LNG would tend to set up its price at. So what's the likely price at which LNG would be setting its price, the likely level? So let us try and work it out. Now all of you should be familiar with this relationship between marginal revenue and elasticity. So marginal revenue is equal to price into 1 minus 1 by price elasticity. Okay, so this is what the relationship is. Now if that is so, let's try and substitute the values, because we need to find out P. This is the unknown. We need to find out P. Now MR is not indicated directly in the problem, but we've been given the marginal cost and we would know that MR is equal to MC. Alright, so the price would be finally set up at a level where your marginal revenue would become equal to marginal cost, because that's a level at which profit would get maximized. So by virtue of that, even my MR should be equal to $40. Price is unknown, and then I have my price elasticity as 1.5. So let's put this and get the value of P. So this is going to be P into 1 minus 3 by 2, which is 1 minus 2 by 3, which is 1 by 3. So that gives me P is equal to 40 into 3, which is $120. Alright, so the purpose behind setting up this question was this particular relationship, which gets very often tested in the exam. Let's move on. Come over to this fifth question. Again, quite an illustrative one, with the intent being to cover as exhaustively as possible the relevant concept. So evaluate investments into equity or fixed income based on the following situations related to the economy. Point 1, Japanese government hinted at a spending plan to the extent of 11% of GDP. So it seems that the government is looking to ramp up its public spending alongside the easing monetary policy of the central bank. So when you have the government ramping up the spending plan, so that indicates an easing monetary policy combined with aggressive spending on the part of the government, which is almost like a fiscal stimuli. So that should result in growth and demand in the economy, demand expansion. And when there is demand expansion, corporates tend to do better, especially the companies which are cyclical, which are part of the cyclical industry. So the suggestion should be that one should look into investing into aggressive growth equity, growth stocks, and should possibly shift their money from the defensive or fixed income to stocks which are more growth oriented. All right, so that's what the appropriate investment would be under the given conditions. Let's look at the second situation. The French government has indicated a decline in labor productivity with a declining trend expected to continue. Now, if this be the situation, that's indicative of an economy which is going to be sluggish, and given those situations, one would advise investing neither in fixed income nor equity belonging to this economy. Alright, move on to the third one. Due to rising inflation, the Central Bank of India has tightened monetary policy, and to stem the deficit, the Indian government has announced spending cuts and tax rate hikes. Now, this is quite indicative of a tightening monetary policy as well as the fiscal one, and if this be so, would result in a slowdown in demand. So there would be a shift back of the aggregate demand curve. So clearly equities would not be the right investment. One might suggest a shift of money from equities, especially aggressive equity stocks, to fixed income and defensives. Move on to the last one. With major oil and gas finds, prices have lowered amidst the government's plan to increase its public spending. So on one front, the economy has been blessed with major oil and gas finds, which is going to bring down the commodity prices, especially that of oil and gas, and should result in a benign inflationary environment. And at the same time, the government is ramping up its public spending. So under the given situations, one would like to believe that equities should benefit, because you have low price environment, low inflation, uh, coupled with government aggressively increasing its expenditure, so the demand should go up, and demand going up with supply costs coming down, that should result in equities getting benefited. As far as the investment in fixed income is concerned, it's a little unclear, so one would advise definitely investing into equity. So let's look at this. With an easy fiscal policy and tight monetary policy, interest rates would decline, government sector would go up as a percentage of total GDP, government sector would decline as a percentage of total GDP. Let's look at the impact of easy fiscal policy and tight monetary policy. An easy fiscal policy is indicative of the government spend, the public spend going up. So the government expenditure would go up. A tight monetary policy would be indicative of less liquidity in the system, and hence, or let's say a rising interest rate, rising real interest rate, which would make it difficult for the private sector to invest aggressively. So there could be a decline in the private sector affairs, private sector activity, coupled with a rise in activity within the public space on account of the rising government expenditure. So net one would like to believe that the government sector's share within the economy would go up. So the government sector would go up as a percentage of total GDP. This looks to be the most appropriate option. Moving on, let's look at the next question. The following exchange rates are being quoted. The Euro USD rate, spot rate, as well as the expected spot rate in the next 1 year has been indicated. The Sterling USD rate, as well as the USD Japanese yen. So what are we supposed to calculate? We are supposed to calculate the spot Euro Japanese yen cross rate. Now the Euro Japanese yen rate has not been given directly, so one would have to combine the three to finally arrive at the Japanese euro combination. Now that's precisely what we mean by cross rate. Similarly, I need to get the spot euro GBP cross rate. Now combining these two, I think we would be able to get the euro GBP cross rate. The third question: is the USD expected to appreciate or depreciate against the GBP? We'll observe the GBP USD quote as it is and what it is expected to be. Is the USD expected to appreciate or depreciate against the Japanese yen? The movement in these two rates will indicate that. And then we need to rank the currencies from the strongest to weakest based on their expected performance. So the currency which is expected to appreciate the most will be termed as the strongest, and the currency which is expected to depreciate the most, or let's say appreciate the least, or rather depreciate, because they are all being pitched against each other, so the one which is expected to depreciate the most will be termed as weakest. So let's get going. So let's first try and interpret these rates. We have Euro USD 1.38. So one would like to believe that the spot rate and the expected spot rate, so let's call it S1, and so this is 1.38, so this indicates 1.38 euro, or rather USD against euro, and then it becomes 1.37 USD against euro, right? That's what the expected rate is going to be. GBP USD 1.57 USD against pound, and then 1.56 dollar against pound. That's what it is expected to be. 76.8 yen against dollar, and then it becomes, or expected to become, 76.7 yen against dollar. Alright, so let's look at spot euro JPY currency rate. So I'm interested in finding out the cross rate. So how would we get it? So let's look at this. I need to take this, this, and this to finally arrive at the euro JPY cross rate. So I need to get rid of dollar, and I need to get rid of okay, I think I stand corrected. I think we could basically use this and this to get it, alright, because it's a euro JPY, so there's no common link, so one can very well avoid this. So we have $1.38 per euro, and we have 76.8 yen per dollar. So that looks pretty simple. So I'm going to take 66.8 yen per dollar into $1.38 per euro. Alright, so the dollar cancels, so we have 1.38 into 76.8 yen per euro. So just do the maths of it. So 1.38 into 76.8, those many or these many yen per euro, that's going to be the euro JPY cross rate. Let's come to the next one, euro GBP cross rate. Now we've been given this rate and this rate. Why not combine these two? So if I may say, I need to get the euro GBP rate. So let's so which would mean, let's be very clear with this, GBP should be there in the numerator. So let me use this space. GBP should be in the numerator per euro. Alright, so this is something that I need to get. Now here you have $1.57 per pound. Okay, so let's have it this way, $1.38 by euro divided by $1.57 by pound. Okay, so by virtue of reciprocating this, my pound would go up. So effectively this would give me 1.38 divided by 1.57. Okay, so this 1.38 divided by 1.57 should be the euro GBP cross rate. So let's now move on to the next one. Is the US dollar expected to appreciate or depreciate against the GBP? Let's look at this. $1.57 per GBP or per pound as it stands now, $1.56 per pound as it is expected to be. So we clearly see that the pound is going to go down in value over time. So the pound is going to depreciate, the US dollar is going to appreciate. So you would say the US dollar is expected to appreciate. Okay, coming over to the next one, is the US dollar expected to appreciate or depreciate against the Japanese yen? Let's look at this. The yen, the dollar value is going to be 76.8 yen, and then it is supposed to go up, or rather go down to 76.7 yen. So to that extent, yen is going to appreciate, dollar is going to depreciate. Look at it, the dollar value actually goes down over time. So one would say yen would appreciate, or rather US dollar would depreciate against the yen. Okay, and that's quite simple. Look at dollar. Dollar is valued today at 76.8. A year down, it is expected to be valued at 76.7. So it's the value of dollars going down. It's depreciating. Okay, and when US dollar depreciates against yen, it's as good as saying Japanese yen appreciating against US dollar. Compare it with the previous question where we were supposed to answer whether the US dollar is expected to appreciate or depreciate against the GBP. Now, your GBP is the base currency, so it's better to pass a judgment on GBP. The GBP value today is 1.57, is expected to go down to 1.56. So we would say, hey, the GBP is going to depreciate. In other words, the US dollar is going to appreciate. Okay, now move on to the last one. Rank currencies from the strongest to weakest based on their expected performance. So let's look at this. Without trying to get into the maths of it, let's see if we can do it very quickly. Rank currencies from strongest to weakest. Now I know US dollar is expected to appreciate against GBP, so the dollar would be better than GBP, and then the USD is expected to depreciate against the Japanese yen, so the yen is going to be ranked higher than the dollar. So this is very, very clear. Now we have the euro as well, the fourth currency which is in discussion. Now look at euro. The spot rate is $1.38 per euro today, and it's supposed to go down to $1.37 per euro. So euro is definitely depreciating against the dollar. Now so is GBP, pound. Alright, so it's just that where do we need to place euro? Now if I look at the kind of decline in euro, it's going to be a decline of $0.01 for on the base of $1.38, while for the GBP it's a decline of $0.01 on a base of 1.57. So clearly the euro is going to depreciate much more. So may I say euro would be taken as the weakest currency. So moving on to the next one, the spot Aussie dollar US dollar is given to us. So let's try and interpret this. This I would take it as 1.02 US dollar by Aussie dollar. May I say that? Okay, carrying forward the previous questions convention. So if that be so, we're supposed to find out the 30-day forward Aussie dollar US dollar exchange rate, given that the 30-day risk-free interest rate in the US is 2%, the 30-day risk-free interest rate in Australia is 3%. Without really getting into the full computation, let me just give you the expression as it would be. Now we all know how to arrive at the forward rate. So we have $1.02. So let's apply the dollar rate. It's 2%. So it's into 1 plus 0.02 divided by 12. Why 12? Because we need to compound it to the extent of 30 days. 2% is the annualized rate, divided by 1 plus the Aussie dollar rate is 3%, so it will be 0.03 divided by 12. So this should give me the 30-day forward rate. Coming over to the 180-day forward rate, current rate, spot rate is 1.02, dollar is in the numerator, apply the US dollar risk-free rate, it's 1 plus 2%, 180 day, so I'm going to effectively take 0.01, which is half of 2%, divided by 1 plus 0.015, which is the half of 3%. Alright, so that's how we would get the forward rates. Moving on, the last question. A country's exports and imports are given as follows. So they have been indicated. The exports in local currency terms is 300 billion. The imports is 270 billion. So clearly the company, rather I stand corrected, the country has a trade surplus. Now the demand elasticity as well has been given for exports is 0.3, which is quite low, and for imports again it's not very high but relatively higher than exports is 0.6. So what are the questions? What is the likely impact of the appreciation of local currency on trade balance? Now we all understand that when the domestic currency appreciates, it makes imports cheaper and exports more expensive for the overseas consumers, so that should tend to ramp up imports vis-a-vis exports, and hence should correct the surplus and make it less. So that's like the predictable impact of appreciation of a currency, isn't it? So it would tend to weaken your exports, it would tend to strengthen your imports, it would tend to advance your imports, would tend to weaken your exports. Now that's the normal response. But given that sometimes when you have poor demand elasticities, the impact might, the likely impact might not fully play out. So we need to see that whether the likely impact of appreciation, whether the impact of appreciation is going to be so or not. So we will try to apply the Marshall-Lerner condition, to see what is going to be the likely impact. The next one is, what is the likely impact of complete prohibition of capital flow in or out on the trade balance? Now we all understand that a trade surplus gets evened out by the deficit in the capital flow. So if there is likely going to be more capital outflow vis-a-vis capital inflow, and that would tend to balance out the trade surplus. So in case if there is a complete prohibition of capital flow, that means the capital balance would become zero, then clearly the trade balance would also be forced to become zero. So on account of this prohibition of capital flow, if the capital, if the existing deficit in capital balance is brought down to zero, then it would result in your trade balance as well becoming zero. That surplus would get corrected as well, because the two tend to offset each other. In terms of elasticity and export or import share, what would make the trade balance more sensitive to currency change? So the likely impact, or let's say the more generally well understood impact of currency appreciation, is that it would tend to push up imports and push down exports. Or let's say if there's a currency depreciation, it would tend to push up exports and push down imports. So what could enable the trade balance to behave so in response to the currency appreciation or depreciation, as we've just discussed? So the Marshall-Lerner condition is given as weight of exports into elasticity of exports plus weights of imports into 1 minus the elasticity of imports. Now this should be greater than 0. So as long as this condition is met, a currency depreciation, let's say if the local currency depreciates, it will tend to bring down deficit. So if there is a trade deficit, that would be that's more likely to come down. Okay, as long as this condition is met. So let us see if this condition is getting met, and in case if there is a local currency appreciation, that would tend to bring down surplus. Now that's going to be the likely outcome as long as this condition is met. So these were the general outcomes that I was talking about to begin with, but the condition being that that this particular inequation should hold true, and this is known as the Marshall-Lerner condition. So let's try and substitute. So we have the weights as weights of export will be 300 divided by 570 into 0.3 plus 200 divided by 570 into 1 minus 0.6. So let's see what it turns out to be. Okay, just a small correction. This should be minus and this is plus. So it's EM minus 1, or else I take minus over here. So this is 0.6 minus 1. Now this would give me minus 0.03. Alright, so this is not meeting the Marshall-Lerner condition. So one would say that the likely, the intended correction in surplus on account of, let's say, the local currency appreciation will not play out, simply because the Marshall-Lerner condition is not getting met. Alright, so what is the likely impact of the appreciation of LC on trade balance? So in case if the Marshall-Lerner condition would have been met, the appreciation of LC, local currency, should have resulted in a decline in trade surplus, but that would not happen simply because the Marshall-Lerner condition is not getting met. What's the likely impact of the complete prohibition? I think that's we've already touched upon. Third question, in terms of elasticity and export-import share, what would make the trade balance more sensitive to currency change? So let's look at in terms of the expression. What would enable the expression to become greater than 0, which currently is negative? So one would suggest, uh, I mean, let's look at in terms of weights. So if the elasticities do remain unchanged, uh, in case if the weight of Wx was much greater, that would tend to put greater weightage on the positive value of Ex, rather than, because remember the weightage of imports is on this negative value. So in case if the weightage of exports was greater, that could have resulted in the Marshall-Lerner condition to be greater than 0, and in that case the trade balance would have been much more sensitive. But given that exports doesn't seem to corner that kind of a dominating share within the entire exports plus imports spectrum, so it's not the exports or imports proportions which are going to play a role. It's rather going to be the elasticities, and clearly the elasticities, both of them carry a positive sign. So a rising elasticity of exports and a rising elasticity of imports would result in the trade surpluses, or let's say the trade deficits for that matter, becoming much more sensitive to currency appreciations and depreciation. So they would tend to be much more corrective in response in case if the elasticity of exports and the elasticity of imports are higher. Okay, so there we come to the close of our economics session. So there I am, Amit Parakh, signing off, and promise you that we're going to come very soon with our top 10 in fixed income. Thank you.